Hey, what is going on, guys? It's your boy Nick, and today we have to talk about a very important topic affecting the stock market and investors right now, and that would be inflation. Now, according to Investopedia, inflation is defined as a sustained increase in the price of goods and services over time. And despite inflation being the negative headline of nearly every financial news outlet today, it is actually a good thing for our economy at the end of the day. Inflation is simply an indicator that people have confidence in the economy and that they're willing to spend their money today rather than tomorrow. That's because inflation erodes the amount of purchasing power that you have over time, thus the amount of money that you own will decrease in value. So the consumer thought goes something like, I might as well spend my money today rather than hold on to it and have it be worth less tomorrow. As opposed to deflationary periods where prices are falling and consumers are delaying making purchases if they can, anticipating lower prices in the future, which of course hurts the economy. However, while a small amount of inflation is very good for the economy, it actually does no benefit for the consumer because the value of their dollar is going to be decreasing over time and they won't be able to keep up with inflation unless they invest in assets. Now in this video, I'll be answering the very simple but very important question, should you be worried about big inflation coming soon? And as an investor, what is the best approach to take to this? So if you guys do enjoy this video, make sure to drop a like. It does really help out my channel. And then if you haven't already, definitely consider subscribing and turning on those bell notifications so you don't miss any of my future uploads. But with that said, let's talk about inflation. Alright, now the first concern that I want to elucidate in this video is the fact that inflation is much higher than expected. Now, the most common measure of inflation that most people tend to rely on is known as the Consumer Price Index, or CPI data. CPI measures the weighted average price of a basket of consumer goods and services over time and then compares it to earlier years to get a decent measure of inflation. And this so-called basket of goods includes everyday products such as food, coffee, clothing, housing, transportation, energy, medical expenses, and much more. Now, according to CPI data, over the past 25 years, the inflation rate across the US has been about 2% per year on average. But more recently, we've seen the inflation data come out for April of 2021, and this completely shocked the market. The most recent number of inflation came in at 4.2% year over year, higher than expected by the Fed, which was the largest 12-month increase since September of 2008. So guys, just keep in mind the last time we saw inflation this high was over 12 years ago now, so that's pretty insane. However, while this recent 2021 number might seem really high, it actually isn't in reality because we're actually comparing it to April of 2020, in which there was no inflation. So even though we might see these higher inflation numbers in the short term, it's not representative of how we're going to see it over the next few years. So when we start comparing back to 2021 and 2022, the numbers are probably going to equalize out at about 2 to 3%. But there's also another issue when it comes to relying on CPI data, and that is the fact that we as consumers purchase a lot more than what is included in the CPI data calculation. For example, some exclusions to the CPI basket of goods are the principal cost of owning real estate or land, stock prices, certain commodity prices, raw materials, and much more. So despite the Federal Reserve stating that they're going to try and keep inflation at around 2% over the next several years, it doesn't paint the entire picture, and we can continue to see potentially hyperinflation among different types of goods, services, or assets in the short term. For example, we can see here that the price of lumber is absolutely skyrocketing, and it has been ever since the beginning of the pandemic, which is not included in the CPI data, but rather the Producer Price Index, or the PPI data. We can even take a look at the price of copper. It's at a 10-year high. Steel too, it's at a multi-year high in terms of price. These are just some examples of raw materials that aren't included in the typical CPI data calculation, but they are inflating like crazy. And why this is so dangerous is because companies that are going to be purchasing steel or purchasing copper to erect buildings or produce machinery or anything like that, it's going to end up costing them a lot more, and they're going to have to pass on the price to the consumer. So many people argue that inflation in real terms should be a measure of everything purchased in the economy, whether it be a home, investment, or bread, and not just based on the CPI data. Secondly, we need to talk about the Fed and how Jerome Powell could single-handedly crash the stock market for one simple reason. But let's backtrack for a minute to really understand what's going on. So at the start of 2020, Jerome Powell, who's the chairman of the Federal Reserve, stated that he doesn't plan on raising interest rates likely until 2023 to ensure that the economy completely recovers from the upset of the pandemic. And as a result, investors believe that the economy is going to be heating up significantly significantly from all of the new money that's been introduced into the economy back in 2020. Like guys, just take a look at how much new money was actually produced in 2020. It was absolutely outstanding and definitely the most in any year in history. As a result, just as I stated in one of my earlier videos, investors have a higher risk appetite, so they're willing to put a lot more money into these higher growth stocks to try and benefit from the recovering economy. However, the opposite side of the equation just means that bonds are in lower demand because stocks and bonds are always going to be balancing each other out because of investors' willingness to purchase bonds or stocks. This ends up driving down bond prices while their yields become much higher and more attractive to compensate investors for future potential inflation. Put simply, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yield to compensate for inflation risk. And as we've seen lately, there's been a huge uptick in the 10-year Treasury yield, which is largely considered the risk-free rate of money. So as the yield continues to rise on bonds, it makes stocks much more or less attractive because they could be investing their money into bonds and taking very little risk. All right, now that we've got the basics out of the way, how could the Fed crash the stock market? Well, if inflation continues to rise at a faster rate than Jerome Powell initially expected, this could mean that he could have to go back on his initial commitment to not raise interest rates until 2023, meaning that we could potentially see interest rates rise sometime throughout 2022, or in the worst case scenario at the end of 2021, which of course would be a huge catalyst for a sell-off in the stock market. In fact, the Treasury Secretary Janet Yellen recently came out and said that interest rates might just have to rise to prevent the economy from overheating. And if this were to happen, we could see bond yields continue to rise even higher, which would put more pressure, downward pressure on stocks. As Warren Buffett has always said, interest rates act like gravity on stock prices. And that's for two reasons. First of all, borrowing debt becomes a lot more expensive for growing companies. But secondly, the opportunity cost of investing in bonds is a lot lower because investors will have a lot less risk getting that yield in bonds. Both of these factors put a lot of downward pressure on stock prices, especially those that are growing very quickly and also have negative free cash flow, so they're relying on debt to fund their operations. So for now, yes, a premature interest rate hike is a major concern for investors, and we'll just have to see how this goes over the next few months and see how the inflation data comes in, and just basically hope that the Fed doesn't go back on his commitment to raise interest rates too early, because otherwise we could see a sell-off in the stock market. Finally, investors are extremely worried about one last factor that is related to inflation, and that is the fact that asset prices are basically at all-time highs right now. Now, most of you that watch the channel all the time will certainly know that the best way to avoid inflation is to pile your cash into assets. Otherwise, leaving your cash in a checking or savings account is only going to be eaten away by inflation over time because the interest rate is so low. But given the fact that since the bottom of the market in 2020, literally every single asset class has risen to all-time highs, this leaves investors with very few choices in which to invest their capital. Firstly, we can take a look at stocks. The S&P 500, which tracks the top 500 companies across the US, is currently trading near its all-time high. We can even look at real estate, which has seen one of the biggest booms in years, with home prices selling above asking prices in many regions across North America. Cryptocurrency has even been a big area of investment recently, with Bitcoin and Ethereum near their all-time highs. And as I showed you earlier, commodities are absolutely exploding in price, with steel, lumber, copper, etc. all near their all-time highs. So the question is, where should investors be focusing right now to be able to earn a return on their money? Well, despite stocks for the most part being near their all-time highs, they actually aren't that expensive right now. Recently in Berkshire Hathaway's annual general meeting, Warren Buffett was asked the question, what are your thoughts on sky-high growth stocks right now being extremely expensive? And surprisingly, Buffett responded by saying stocks are actually a bargain right now considering how low interest rates are. And I, for one, actually completely agree with Buffett here. And to be honest with everyone, despite all of these concerns about inflation in the short term being extremely high, I really don't see this affecting the fundamentals of very good businesses with very good growth, including many of the tech companies that I own in my portfolio. All right, so now I'm going to be giving you guys my two-part plan for how I'm going to be investing moving forward and basically dealing with my finances. So the first part is focused on reducing my cash exposure and focusing on investing a lot more of that money to avoid it from being eaten away by inflation. I still do think it's very important to hold a little bit of cash on the sidelines for opportunities in the market, but but by no means do I want to be holding more than 20% cash in my portfolio. Like, I think right now that's just a bad decision because inflation is coming very quickly and very strong. And the second part of my plan is going to be focused on investing in resilient businesses that are undervalued, producing very large amounts of free cash flow. When a company is very profitable and they're able to produce their own free cash flow, this means that the business does not have to rely on debt to be able to fund their operations. And consequently, these companies are going to do a lot better during times where there's rising interest rates and rising inflation. So basically, I'm trying to avoid companies that both come across as very speculative, but also those that don't produce any cash. And I honestly don't see any need to be looking for speculative investments right now because so many of the good tech companies are trading at very low valuations compared to historically. So I think there's so much opportunity out there right now just to funnel your money into companies with a lot of free cash flow. For example, I've talked about Facebook and Amazon on this channel quite a lot. I'm still very bullish on these companies, and I will continue to plow money into these free cash flow producing businesses, and I think they'll continue to do very well despite there being inflation or not. So overall, I don't think we should worry too much as investors about inflation or any of these worries in the short term. Like in 10 years, we're not going to be looking back and saying, oh, there was 4% inflation in 2021, that just destroyed our returns. Like, no, that's probably not going to happen. But we do need to understand that the most important thing we can do in these inflationary times right now is to be invested in income producing assets to be able to protect us from this inflation. Whether this be in real estate or stocks preferably, it doesn't really matter. It just matters if you're staying invested and you're not holding too much cash on the sidelines. But yeah, that basically summarizes all of my thoughts about inflation right now. I'm still continuing to invest as normal. I'm finding great opportunities in the market right now, and I think you guys can too. So with that being said, if you did enjoy this video, make sure to drop a like. As always, it does help support my channel. And then of course, subscribe for more content on finance and investing in the near future. And with that said, I will see you guys in the next one.